The pace of Canadian inflation picked up for the first time in 4 months in June. But will it be enough for the Bank of Canada to cut interest rates at their meeting later this month? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. And Robert, thanks very much for joining us. As I mentioned, we've got the latest Canadian inflation report. What's your headline reaction?
Thanks, Anthony. Well, headline inflation was a little bit stronger than we'd anticipated. We thought we were going to see an increase from 1.7 to 1.8. We ended up seeing a slightly larger increase to 1.9, but that was still in line with where the market thought the report would land. Now, the details were a little bit more hawkish than just those headline numbers would imply. So the Bank of Canada is more focused on underlying inflation right now. Their preferred core inflation measures did tick a little bit higher. They're now sitting at about 3.05%, so just above that target range. And on a 3-month annualized basis, those core inflation measures are sitting closer to 3.4%. So even though headline is still slightly below the 2% mark, we are still seeing more pressures across core inflation measures, and that is going to give the Bank of Canada a little bit more pause as they approach that policy decision on July 30th.
Okay, so you said we're starting to see some of that pressure from on core inflation. Are we starting to see any impacts from those U.S. tariffs in the data? And if not, how soon are you expecting that to happen?
So we're still not seeing much tariff impact in the data. Canada has pared back a lot of its tariff response since it was first announced over March and April. So, right now we've imposed countermeasures against about $60 billion. A large portion of that is intermediate goods like steel and aluminum products. If you just look at the consumer goods where you would expect to see a little more tariff pass-through, it's really food products and some household goods as well. And we're not seeing a ton of pass-through in the inflation data. In fact, food was one of the few components to actually see deceleration in the month of June. Food inflation is back down to 2.9%, off half a percentage point from 3.4 in May. I think what's important to note there is just that, even as counter tariffs have been coming into effect, we've also seen a pretty strong downward push from a stronger Canadian dollar. So anything we import has gotten cheaper in Canadian dollar terms. So that FX pass-through is helping to drive more deceleration in those non-durable goods.
Okay, what about the shelter component of CPI? What are you seeing there?
Yeah, so shelter has been one of the key drivers for the deceleration over the last year and a half, really. As the population growth has slowed, you've seen more downward pressure on shelter prices. Whether you're a renter, a homeowner, or someone who's trying to break into the market. And we did see a bit of a pause in rental disinflation. Rent inflation actually ticked up a bit. Rents themselves didn't move much higher, but there was a very weak month in June 2024. So it's a little harder to see that continued progress. But we did see a little bit more deceleration come through owned accommodation, so homeowner replacement costs, the cost to build a new house. Those continue to decelerate. You were seeing smaller contributions from mortgage interest costs. So as more homeowners on variable rate mortgages, or anyone who is coming off of a short-term mortgage that was signed after the pandemic, those smaller increases are bringing some downward pressure on shelter. And with that, total shelter inflation is now back under 3%. We are seeing that gap between shelter and ex-shelter continue to diminish.
Okay, so given this latest numbers, what does this mean for the Bank of Canada, which meets later this month?
I think, if we back up to the Bank of Canada's decision in June, at the time they said, to contemplate further cuts, we're going to need to see more evidence of contained inflation pressures and more evidence of softer growth. We've certainly seen it on the growth side. We saw output contract in March. Statistics Canada's flash estimate is pointing towards another decline in activity in May. And even in that May CPI report, you did see some early signs of stabilization, but with core inflation back above target now, with those higher rates of 3-month annualized inflation, It does put the bank in a much more difficult position because, above all, they are an inflation-targeting central bank. Their mandate is to ensure low and stable inflation. So we think that the window to cut rates had already really passed with the stronger employment data we saw last Friday, but with core inflation sitting above 3% now as well, we think the Bank of Canada is going to remain patient here, and that rate cuts will be a story for later in Q3.
Okay, now we also got data on inflation in the United States. What were your key takeaways there?
Yeah, so the U.S. inflation data, it was a bit of a contrast to Canada. So, in Canada, we saw a headline more or less on target. Core inflation measures were a little bit stronger than expected. In the U.S., it was actually those core inflation measures that surprised to the downside. So you did see a bit of a rally in U.S. fixed income right after that data, but as markets digested that, there were a few components of that report that have been dictating some of the price action since. So core goods was a big driver of inflation in the U.S. We saw acceleration from May to June, and some of that is more reflective of tariffs than the core goods inflation we've seen in Canada. So U.S. effective tariff rates are significantly higher. The U.S. has imposed tariffs on virtually all of their trading partners, whereas we have just imposed them against some U.S. products. So there is a lot more tariff impact coming through U.S. inflation, and that has gotten the market a little bit more nervous about the prospect for Fed cuts later this year. So even though core inflation came in a bit stronger, the market is treating this as more of a hawkish report on balance.